Hi, welcome back to Traveling Trading Zone. I know it's been a minute. I was supposed to come back, but it's been some things going on in my family that I had to take care of. But I'm back, and hopefully, if you were on the first live, you was able to get the book Trading in the Zone by Mark Douglas and start reading it. We already reviewed chapter one. If this is your first time here and you want to review the chapters with us, go ahead and get caught up to chapter two. We will review chapter two tonight, and then tomorrow. Excuse me, not tomorrow. Next week, by next Thursday, we'll review chapter three. Okay, so this we're reviewing chapter two, Trading in the Zone by Mark Douglas. So let's go ahead and get started. All right. So chapter two is talks about the lure and the dangers of trading, and it discusses about um, helping traders develop the mindset for consistent success. The book teaches traders to approach the market with the right psychological framework, and it focuses on overcoming fear, greed, and other emotional pitfalls. Technical analysis and strategies can only take traders so far. So psychological discipline is the determining factor in consistent trading success. So psychology, what this book teaches us is in every chapter, it reiterates how psychology is just, if even not more important than technical analysts. Because if you think about it, most majority of people are smart. They can learn something. You could once you taught something, you know how to do it. We can learn how to trade, but we have to learn to train our minds because that is what's going to help us be successful. And this chapter talks about the lure and the dangers of trading and why it's so important that our psychology is on point. Okay, so chapter two, introduction. So the key points in this chapter is trading appeals to many because of the promise of financial freedom. You see the people with the flashy lifestyle and they showing how much money they made, or they may show their chart. So it can be very appealing because it it can open the door to a very good life and financial freedom, just as it says here. However, this allure often blinds traders to the psychological dangers. Chapter 2 explores the emotional roller coaster and challenges of trading. So, you may ask, why is trading so attractive? Trading is attractive, especially forex. Trading forex is attractive because of the potential, one, for the potential of unlimited profit. The ability to make large amounts of money quickly is very enticing. There, and also it's unlimited potential of how much you can make. There is no cap on earnings. So that creates a sense of a boundless opportunity. So it's no cap. Literally no cap on how much money you can make. So that's one of the reasons that trading is so attractive. Freedom and independence. So trading offers a chance to work independently, free from a traditional job, a 9 to 5, or something outside the home, away from your family, long hours, long nights, even though it does take some long hours and long nights to learn and get to learn how to trade and how to trade successfully. But eventually it does create that independent less stressful rat race lifestyle. And it's also gives you the chance to achieve the dream of being your own boss. If you agree or not having a boss, be your own boss and run yourself, run your charts. So that's also why training is so attractive. And the third reason is it's a level playing field. So the market is open to anyone that long as you have capital, you can start an account with $50, $100. I've seen some people put $10 on the account just to get started, just to get some practice in with real money besides demo. So it's open to anyone, as long as you have money, and it also creates the illusion that success is purely merit based. Well, it eliminates that illusion because it's basically saying it's open to anyone. It's the same. Everybody has the same opportunity to make money. So the reality of trading. The reality of trading is that one of the realities is even it contains high risk and high emotion. So trading involves financial risk that triggers intense emotional responses. And because of that, fear and greed sometimes can dominate your decision making. It's similar to sometimes like if some people do horse betting or sports betting, and you put your money online, you watching the game, and you get emotional because your team you betted on is not doing what you expected them to do. And so it can raise your emotions is all over the place. It's the same thing on the charts. You say you think the trade is going to be expected to do this, and then sometimes it goes your way and sometimes it doesn't, and your emotions can be all over the place if you don't take the time to learn and train your mind to handle those types of ups and downs. The market can be very unpredictable. So markets do not always follow logical patterns, challenging even the most skilled traders. So this goes to something my mentor would say: trade what you see, not what you think. Because you may think logically, you looking at the chart like, oh yeah, for sure, it's definitely price is definitely going to go down here. It's going to go down. I know it's going to go down. I think it's going to go down. Girl, yes, it's about to go down just because you see a bearish candle. And then next thing you know, it wicks out and goes in the opposite direction. And then you're like, but why would it do that? That doesn't make sense. And that's what Forex is. Sometimes it doesn't make sense. The market is going to do what the market wants to do. And you just have to be ready for those unpredictable moments. And there is a learning curve. So many new traders underestimate the time and effort needed to develop the skills and mindset because the income revenue you can make from trading has no cap and is unlimited. People expect to get in, learn trading really quick, and like make a whole lot of money really, really fast. And the truth is, it doesn't work like that. It takes time. It takes hours of um, back testing, studying, you know, mentorships, coursework. It takes that time to learn it. Is really like going to get a 4-year degree, a 2-year degree, depending on your skill set or the program that you may be learning in. It can take some people up to 5 years before they begin to turn a profit because it's not a get rich quick scheme. This is a real skill set that if you take your time, put your time in, and really study this, you can reach those levels, those unlimited income. You can have that lifestyle, but it does take time. And a lot of new traders underestimate that. So some of the emotional challenges with trading that the book talks about is lose the fear of loss. Nobody wants to lose. Nobody wants to lose money. So when someone does lose money, it can create some sort of anxiety, which also leads to hesitation or poor decisions. Okay, you may learn a strategy and that strategy may work 75% of the time, and maybe 25% of the time it doesn't work, and so you take some else. But That doesn't mean that, oh, you took an L, oh, my strategy don't work, oh, what I want to do, I need to learn something else, or try to find out another way, where it's like, okay, I know this strategy works 75% of the time because I'm tracking my trades and I see out of, let's just keep it simple, out of 4 trades, I lost one and I won 3. So therefore, I have a 75% win rate. That means that my account is going to increase over every time. I may take some losses here, but I still gain overall. So that learning, having that mindset and not being afraid to lose money and expect to lose money, so that way you don't make those poor decisions, and which can just be a domino effect for a failure. Another challenge is greed and overconfidence. So sometimes you may get on a winning streak, you win it, you feel like, okay, I got this. I know, this is it. I'm a put, um, you know, a way bigger lot size than what your account can even handle, and trade effectively, which basically is just being greedy and overconfident, because, like we said before, the market is unpredictable. So yeah, you can be confident in your skill set, but at the same time, you don't want your overconfidence to overshadow what's really going on and cause you to take unnecessary risks, which is over leveraging, which could end up wiping out your whole account. So those some of the challenges we go through, because we all want to win, we all want to make a lot of money, but we just have to monitor and make sure that we are taking the necessary risks and not putting our account in jeopardy. Another challenge is frustration and revenge trading, and this is a big one that the book talks about, because after you lose a trade, some people I'm even guilty of this myself in the past. When I first started out, I was like, oh, okay. Oh, hit my stop loss. Oh, my stop loss was too close. I'm about to get in again, or I'm about to sell or for more money or whatever. At the end of the day, if you don't take the time to evaluate why you lost that trade before you enter another trade, then it's just most likely going to lead to more losses. So, and it's hard starting out. So those are some of the emotional challenges that the book talks about in chapter 2. So the psychological pitfalls. One is the illusion of control. So the book talks about how many traders believe they can predict or control the market movements. This belief leads to that overconfidence we just talked about and risky behavior. It may cause you to over leverage your account, which puts your account at risk of being blown out and losing everything you worked hard for. And just that overconfidence and thinking you can predict the market, when really it's not. It's bigger than predicting the market. It's analyzing the market and taking those risks with the highest probability that price is going to go in your direction. And you have to know that you're not going to be right all the time. And when you lose to win again, because you lose, you take the L, you evaluate why you lost, you take note of it, and then you look for another entry. And it may not be that same day. It may be the next trading week, or maybe the next day. Sometimes when you set your rules for your trading, I would suggest you say, okay, I'm not gonna risk more than 10% of my account per day. So if I lose, if 10%, if I have $3,000 in my account, and I say if I lose 10%, which is $300, I'm done trading for the day, or I'm done trading for the week. However you choose to do it, but setting those rules can kind of help you with that, with avoiding risky behavior. 2, random rewards. So the market's occasional random rewards can reinforce bad habits, creating inconsistency. So what this point is describing is sometimes you may enter a trade that you wasn't 100% confident in or sure about, and you entered it anyway. And let's say you didn't know, but the news came out, and then boom, within 30 seconds, your TP is hit, and you hit for, let's just say, keep it simple, 100 pips. Okay, so now that's have you feeling like every time it can have someone feeling like, oh, I hit my hit TP within less than 5 minutes, when in reality is, especially if you're an intraday trader. Now if you're a scalper, that may be possible a few hours, but let's just say you're an intraday or a swing trader. You know that most of the time when you enter a trade, it's going to take time, and you have to have patience for it to pan out. So you don't want to, lose confidence when you enter a trade and it's taking longer to reach your TP level because maybe the market is not, it's not a lot of volume going on at the moment, or it's the trade is still setting up. So it may take time for it to play out. So you have to have patience. You don't want to let yourself down just because it's taking longer. But your analysis is on point, because there's plenty of times you may be like, oh, well, this trade is taking so long, I'm just going to close it out. You close it out, you wake up the next morning and you see it hit take profit while you were asleep. So that's just something, um, an example of a random reward that the market could give, which could lead to inconsistency, especially if you take a trade that you didn't really study, you just saw a candle close and you jump right in, and then it hit your take profit. You say, okay, I could do that anytime, and then you do that again, and what happens? Boom, it goes the other way. Lose the trade, blows your account, blows your confidence, and it's just not a good place you want to be in. So, you just have to just be mindful of those situations where, everything is not always going to be the same every time. Another psychological pitfall would be failure to accept losses. So, sometimes it can be hard to accept the fact that you're losing the trade, and someone may feel like they're a failure because they're losing the trade, but it's really, all that means is that you are learning, and you just have to tweak, your mistakes, or find a source, or find um, a resource that can help you overcome that hurdle that you may be going through. And some people it may be hard for them to accept the fact that they lost, so they may get angry. They may say they don't want to trade anymore, or you have some people that call forex a scam because they weren't able to learn it the proper way, which caused them to lose a lot, which made them feel like they were failures. So that's just something to keep in mind. It could be. So another thing the books talk about is overcoming the dangers of trading. So the first thing the book chapter 2 mentions is recognizing and understanding your emotional triggers and biases, which is basically developing self-awareness, being aware and understand what's going to trigger you. And when I think about this point, I think about, if I'm not having such a great day or a great moment, or I'm upset, there's something else going on outside of trading, then I know, for me personally, I don't need to be trading. I don't care if my alerts are going off, or I get a signal from whatever. No, I'm not going to take the trade. I'm going to take the time to work, to figure out or go through my emotions and figure out exactly what's going on. It's not related to trading. Handle that, get myself together. Then maybe I may take a day, the next day, then I'll come back on the chart, because I know emotionally my mind isn't there. My mind is on something else. So you just have to know yourself. Like really trading is really getting to know yourself and knowing what triggers you and and implementing that into your trading plan. Um Point number two would be building discipline. So, like I just mentioned, you want to stick to a defined trading plan and avoid impulsive actions. So, what that means is in your trading plan, you should say, okay, I need this, and this. Let's say 3 points to, or four. I got a list of four things. At least three out of those four things have to happen has to be happening in order for me to enter this trade. Or if this trade doesn't go my way, then I'm not going to trade for the rest of the day. Or I'm only risking this percentage of my account. Like you have to be very, very specific in your trading plan and you want to stick to it every time you enter the market. So therefore, you're never making those impulsive actions. And I talked about this in chapter one too, but I mean the book talked about this also in chapter one, and I had it on the slide. And it talks about having that probabilistic mindset, which means that trading, you have to accept that trading is a game of probabilities, not certainties. There are no guarantees here. This is not Walmart, Target, Kroger. There's no guarantees on this chart, on these charts. So you have to come with that mindset. It's a probability. It's a chance based on past behavior on the charts. I can expect the market to do this. Based on my trading plan, I'm going to enter the market when these conditions are met. I'm going to exit the market when price reaches this amount or this point or however whatever your trading strategy is. You want to stick to that and also keep in mind it's all a probability. Although it may not work 100% of the time, as long as your wins are outweighing your losses, you may lose. You may take 5 trades and lose two, but you still won three. And then maybe the next week you may take 3 trades and only win one. Okay, but then that following week, you may take 5 trades and win all five. So it's all a game of probabilities, not certainties. And once you get that strategy that works, be consistent, you can overcome all these dangers in trading. So the key takeaways from chapter two is that one, trading is as much as mindset as it is about strategy. So understanding your emotions is critical for long-term success. So understanding your emotions, understanding yourself is very critical for your success and being successful in this trading game. Two, the allure of trading can lead to dangerous psychological traps. So make sure recognize these traps to avoid falling victim to them because we don't want to be over leveraging or being too overconfident or thinking this is a get rich quick scheme, which is not. So we want to recognize those traps and avoid falling victim to them. Three, success requires discipline, awareness, and acceptance of losses. A professional approach to trading reduces emotional decision making. And that basically speaks for itself. You know, we not we have our emotions in control. We are trading off of our trading plan. So it's a professional approach. It's not all willy nilly. It's not just buy sell. It's a professional approach. It's just like any type of company. They have these type of protocols in place. When these protocols are met, then this can happen. It's the same thing. It's cause and effect. It's a chain reaction. It's impulse, correction, continuation. You know what to do. So, as for our reflection and action steps, I want you to examine your motivations for trading. Are you trading for what is your why? Are you trading for freedom, excitement, or consistent income, or all three? Just examine your why. Two, I want you to identify any emotional pitfalls you've been experiencing while trading. So note the patterns of fear, greed, and overconfidence. Once you can recognize those patterns and those feelings, you can tackle them and you can overcome them to be successful. Three, I want you to commit to developing a disciplined trading plan. Create specific rules for entering the market, exiting trades, and stick to them. That's the only way. That will take you very far in this trading game. If you don't do anything else that I'm telling you, I just say please, please, please create a trading plan and stick to it. All right, so that was chapter two review for Mark Douglas' book, Trading in the Zone. So with that, I hope this presentation was beneficial for you. If you have any questions, feel free to leave them in the comment section. Don't forget to like the video, share, and subscribe. And I'll be back later on next week with chapter three. And don't forget, you can purchase Trading in the Zone on Amazon, your local bookstore, and it's also available audiobook and Kindle version. Thank you for joining and have a great week.